let's talk about something that sends a shiver down the spine of even the most seasoned crypto investor: taxes. If you've been involved in the world of digital assets, you've likely heard whispers and warnings, but the reality is often more complex than most people imagine. The Internal Revenue Service, or IRS, has made its position crystal clear. Cryptocurrency is treated as property for tax purposes. This single designation has profound implications. It means that, unlike traditional currency, nearly every single thing you do with your crypto is a potentially taxable event. Think about your activity from the past year. Did you sell some Bitcoin when the price was high? That's a taxable event. Did you swap your Ethereum for a promising new altcoin on a decentralized exchange? That's also a taxable event. Did you use some of your holdings to buy an NFT, or even something as simple as a cup of coffee? Believe it or not, each of those is a taxable event, too. Every trade, every sale, and every conversion creates a data point that the IRS expects you to report. This is the part that catches almost everyone by surprise. The common belief is that you only have to worry about taxes when you cash out your crypto back into US dollars and see the money in your bank account. Unfortunately, that's a dangerous misconception. The truth is, you could have a portfolio that's down overall for the year, yet still owe a significant amount in taxes. How is that possible? It's because taxes are calculated on a trade-by-trade basis. You might have sold one asset for a profit in March, creating a tax liability, even if you later lost that profit on another investment in September. For anyone who has done more than just buy and hold a single coin, the task of untangling this web of transactions can feel impossible. We're talking about potentially thousands of transactions across multiple exchanges and wallets. You have to track the exact date, time, and US dollar value for every single acquisition and disposal. This is your cost basis, and getting it wrong can lead to overpaying your taxes, or worse, facing penalties from the IRS. The manual process of gathering this data, organizing it in a spreadsheet, and calculating the gain or loss for each event is a genuine nightmare that can take weeks of painstaking work. But what if it didn't have to be that way? What if you could automate this entire process, turning weeks of stress into about an hour of guided, straightforward steps? That's where modern technology, and specifically AI, comes in. In this video, we're going to demystify crypto taxes completely. We'll show you, step by step, how to connect your exchanges and wallets to specialized software, how to automatically categorize your transactions, and how to generate the exact IRS forms you need to file your taxes correctly and confidently. We'll even explore how you can use simple AI prompts to understand complex scenarios. So, take a deep breath. Your crypto tax nightmare is about to end. I am not a tax advisor. This is educational information, not tax advice. For your specific situation, consult a tax professional. That said, let me walk you through exactly how AI-powered tax tools work. Why crypto taxes are confusing. Let's start with the single most important concept you need to understand, because it's the root of all the complexity. In the eyes of tax authorities like the IRS in the United States, cryptocurrency is not treated like currency, such as the US dollar. Instead, it's treated as property. Think of it like a stock, a piece of real estate, or a collectible. This one distinction changes everything. Because it's property, anytime you get rid of it, or what the IRS calls disposing of an asset, you trigger a potential taxable event. This is where the confusion begins for so many people. You might think you're just using a new form of money, but the government sees you as bartering with digital property. So what does that mean for you? It means you have to calculate a capital gain or a capital loss on every single one of those disposals. A capital gain is the profit you make. You owe tax on this gain. That's RGUM. It's calculated as the difference between what you received for the crypto and what you originally paid for it. The amount you originally paid, including any fees, is called your cost basis. The value you got when you sold, traded, or spent it is your proceeds. The simple formula is proceeds minus cost basis equals your capital gain or loss. If you have a gain, you owe tax. If you have a loss, you don't owe tax on that transaction. And you may even be able to use that loss to offset other gains, which is a strategy we'll cover later. Let's look at the most common taxable events. The first is trading one cryptocurrency for another. If you traded Bitcoin for Ethereum, that's a taxable event. This is a huge point of confusion. Many people assume that because they didn't cash out into dollars, there's no tax. That's incorrect. From a tax perspective, You effectively sold your Bitcoin for its fair market value at that exact moment, and immediately used the proceeds to buy Ethereum. You have to calculate the capital gain or loss on the Bitcoin you just disposed of. Now, imagine doing this with dozens of different altcoins. Every single swap is a taxable event. The second common event is spending. If you bought a coffee with Bitcoin, that's also a taxable event. It seems absurd, but it's true. You are, in the eyes of the law, selling your Bitcoin for the exact price of that coffee. Let's say the coffee costs $5. You are disposing of $5 worth of Bitcoin. You must then look back at what you originally paid for that specific fraction of a Bitcoin. If you bought it when the price was much lower, you've realized a capital gain on the transaction, and technically, you owe tax on that tiny profit. Yes, even on a cup of coffee. And of course, the most obvious taxable event is selling your crypto for fiat currency, like US dollars. This is the one most people are aware of. If you sell your crypto on an exchange and withdraw the cash to your bank account, you have very clearly disposed of your asset, and the gain, or loss, needs to be calculated. The problem is that these events add up with incredible speed. If you've been trading actively, using DeFi protocols, or even just swapping between a few coins, you could have hundreds, or even thousands of taxable events in a single year, and not even know it. Each one requires its own calculation. You need the date, the cost basis, the proceeds, and the resulting gain or loss for every single transaction. Manually tracking this is not just difficult. For most active users, it's practically impossible. This is the core of why crypto taxes are so confusing, and it's the exact problem we're going to solve in this video. How Coinly works. Connect your exchanges and wallets to Coinly. It automatically imports all your transactions, calculates your cost basis for each, identifies every taxable event, and generates a tax report you hand to your accountant or import directly into TurboTax. The AI flags anything unusual, calculates your losses to offset gains, and tells you exactly what you owe. Now, let's talk about a tool that many of you are probably already using for 100 different things: artificial intelligence. Specifically, can you use something like ChatGPT to figure out your crypto taxes? The short answer is, for very simple scenarios, yes. It can be a surprisingly helpful educational tool. We'll call this the ChatGPT approach for simple situations. If you're someone who just dipped their toes into crypto, maybe you bought a little Bitcoin or Ethereum once and sold it a few months later, you can actually walk through the basic calculation with a tool like ChatGPT. It's a great way to understand the fundamental mechanics of how a taxable event is calculated without getting overwhelmed by complex software right away. Think of it as a personal tutor for a single straightforward problem. The key is providing a clear, detailed prompt. The AI isn't a mind reader. The quality of its answer depends entirely on the quality of your question. For a simple trade, you'd want to give it all the essential variables. Here's a template you can use. You would prompt it with something like, I bought 0.1 Bitcoin on January 15, 2023, for $2,000. I sold that same 0.1 Bitcoin on December 20, 2023, for $4,000. My ordinary income tax bracket is 24%. Based on US tax rules, what do I owe in capital gains tax? And is this a short-term or long-term capital gain? For a simple case like this, ChatGPT is surprisingly adept. It will correctly identify that your capital gain is the sale price minus your purchase price, so $4,000 minus $2,000, which equals a $2,000 gain. It will also determine the holding period. Since you bought in January and sold in December of the same year, you held the asset for less than 1 year and 1 day. Therefore, it will correctly classify this as a short-term capital gain. It will then explain that short-term capital gains are taxed at your ordinary income tax rate, so it would calculate 24% of your $2,000 gain, concluding that your estimated tax liability for this specific trade is $480. It calculates it accurately for these simple isolated cases. But, and this is a very important but, this is where the utility of ChatGPT for crypto taxes begins to reach its limit. The moment you introduce any complexity, the risk of getting an inaccurate or incomplete answer skyrockets. What if you had 10 trades, or 100? What if you bought Bitcoin on 5 different dates at 5 different prices and only sold a portion of it? This brings up the concept of cost-basis accounting methods, like FIFO or specific ID, which a simple prompt can't easily resolve. What about other types of transactions? If you traded your Bitcoin for Ethereum, that's a taxable event. If you use crypto to buy a coffee or an NFT, that's a taxable event. If you earned staking rewards or yield from a liquidity pool, that's treated as income. These scenarios have different tax implications that require meticulous tracking across multiple platforms and blockchains. ChatGPT, as a large language model, has no access to your live, real-time transaction data from exchanges like Coinbase or wallets like MetaMask. It cannot connect to APIs or import CSV files. Every single piece of data must be manually entered, which is not only tedious, but also incredibly prone to human error. Imagine typing out the details of 500 trades. A single typo in a date or a dollar amount could throw off the entire calculation. So, what's the verdict? Use ChatGPT as a learning tool. Use it to understand the difference between a short-term and long-term gain on a single trade, but do not rely on it to prepare your actual crypto tax report if you have more than a couple of simple buy and sell transactions. For that, you need a dedicated tool that can automatically sync your data, correctly apply cost basis methods, and generate the specific forms required by the IRS, like Form 8949. That's where specialized crypto tax software becomes not just a convenience, but a necessity. Coinly link is in the description. They have a free tier that handles up to 25 transactions. For most beginners, that covers your entire history. Don't skip this. The IRS is increasingly auditing crypto. Subscribe, and tell me, did you know crypto was taxed like this before watching this?